All right. Good afternoon and welcome to our April market commentary. Um, Thank you for everyone who is joining on so far and looking forward to talking to you guys about what we see happening in the markets right now and our opinions on all these things. So as you know, if you're joining onto this webinar, we have moved to YouTube Live. So this is kind of exciting for us. We're on YouTube Live now. We are this is where we're going to start posting a lot of content, both these market commentaries, webinars, and a lot of short form content for you guys to just come in and learn about Roth conversions, tax savings, Medicare, how that interacts with your FEHB. All these things are going to be on our YouTube channel for you guys to learn about, and we're really excited about this new platform. So as we move forward, a couple of housekeeping things. I know last time we had some issues with the chat function that wasn't working for you guys, but we should have that up and running now. So if you have questions, feel free to put those in the chat. We also have here down at the bottom of our screen, you'll see a little QR code. We'll talk about this more as we go through the call and at the end of the call. But what that QR code is for is that opens up a registration page for a free one-on-one call with one of our advisors or financial coaches. So if we go over something today that you want more information about, is personal to your situation, and you want a one-on-one call, that's a complimentary call that you can schedule down using that QR code. And again, we'll talk more about that at the end. So, we used to send out slides and videos for these. We don't do that anymore because it lives on YouTube. You're here now. It'll be uploaded after the call. So if you miss something, you got to leave early. That's completely fine. This will all be uploaded to our page and live right here once it's done. So without further ado, we'll go ahead and get into the content here. So my name's Austin Costello. I'm joined here with David Sedio. We're both financial advisors with Capital Financial Planners. At Capital Financial Planners, we really specialize in helping federal employees plan for retirement and plan through retirement. So, we're not exclusive to feds. I will say that, but a large percentage of our clients are there, and we're really well versed in the federal benefits, federal retirement, and all that. So if you're interested in getting more federal specific financial advice, we're hoping that's what we can add to you. Now, with our market commentaries, this format is really designed to be a conversation about what's going on in the market right now that applies to everyone, not just federal employees, and our input on that. So, David, why don't you get us started with what's going on in the market right now?
Yeah, definitely. So one of the biggest things that has really been a topic, and for anybody who's joined, our past commentaries, I'm sure you've heard this several times over. But the S&P 500, the C fund or stock market, has really had most of its growth driven by now just 6 companies. And if we were to take the same S&P 500 and we were to split that, right, and instead of these companies being weighted based off of their company size, their market cap, and instead have them equally weighted across the board, you can notice how those returns may differ, right? 179% return versus 130% return spread out since about 2015. So when we look at these numbers, we can really see just how much different, right, those company sizes have impacted things really since about 2020 onwards, right, is really where we saw these lines separate. And if we go here to the next slide, we can see how this has played out over history. And one of the main things here is just looking at the top 5 companies. And some of you may recall this, some may not, but back in the early 70s and in the 60s, the stock market was really dominated by several companies, right? Around the same proportion that we're at now, where those top 5 companies equated to about 25% or a quarter of the total market, right? And when we look at this, we can see what happened in the following years afterwards. Now, we're not saying this is going to happen tomorrow, but what we are saying through this is it wouldn't be unreasonable for other companies to start to improve and for these companies to maybe at some point hit a little bit of a wall where they kind of level out a little bit more and become less of a proportion of the total market. So this is something to consider with, outside investments and with your portfolio allocations is, hey, am I putting too much concentration in the C fund, too much towards these, top companies? Because essentially it's just going to take a couple quarters of missing earnings or not, beating expectations to see these come down a little bit more, or just for other companies to also catch up a little bit. The other thing that we'll kind of add in here is this has in times led to recessions, right? Where when a recession occurs, we tend to see these come down a little bit, right? These typically will actually come down more than the average market. So we're not saying a recession is around the corner, but if we were to have a slowdown in growth, which we'll talk about later, then you might see these companies come down a bit harder after they've just grown and jumped so much, as you can tell from the chart here, right? Since about 2017 till today, you can see just how large of a proportion of the total market these have become.
Yeah, and something I just wanted to add in there quickly is when you invest in the S&P 500 or like the C fund in your TSP, historically, you get the feeling that you're well diversified. You're in 500 companies, right? And they're the 500 largest companies in the US. So seems to be a really safe bet. And what we're showing here and what's kind of concerning right now, and we've talked about a lot, is when 25%, a quarter of the S&P 500 is actually only controlled by 5 companies, by a small percentage of the actual index, things get a bit concerning, right? Imagine having 25% of your investment in just 5 companies. Now, these are great companies. Don't get us wrong. Microsoft, Apple, Amazon, right? These are great companies. But that doesn't mean they're immune from kind of market conditions. And the same thing was said back in the 70s about the Nifty 50, right? IBM, AT&T, Exxon, these companies were changing the world. And the narrative was, hey, if you invest here, you're never going to lose money, right? These companies are never going to lose money. They're so big. They're acquiring smaller companies. All the same things people are saying now about Microsoft, Apple, Amazon. This narrative has been said before, and we've seen these, the values and the concentrations of these drop over time. Now, I want to be very clear here and say that we are not saying that these are bad companies or that this is going to happen anytime soon. Okay. When you look at the earnings of these companies compared to the rest of the market, okay, when we look at the contribution to Q4 earnings per share, okay, so how much did each company contribute to the overall S&P 500's earnings growth? Okay, so the S&P 500's earnings growth, how much did each of these companies contribute? Well, if you look at these top 6, okay, they made up 9.3 percent of the earnings per share. Now, if you look at the rest of the S&P 500, just excluding these 6 companies, their earnings growth was actually negative. So what that means is if you took these top 6 companies out that are just dominating the market right now, market earnings would have been negative and market returns likely would have been negative in Q4. But once you factor these in, market growth overall has actually averaged, earnings per share has been increasing. So this is a pretty wild stat when you can see 6 companies are dominating the market so much that they're they are making up for negative returns in the rest of the market and growing the market essentially all on their own. Now, this also poses a bit of a concern, right? The price of these companies is now essentially factoring in that they're going to have these super high earnings going forward. And even if these companies continue to grow, but their earnings didn't grow as much as is being priced in right now, we could see some pullback in price. But that hasn't happened so far. When we look at year to date, and this is just for 2024, right? So the first 4 months of 2024. If you look at year to date return by the price to earnings ratio. Okay, price to earnings ratio. This is something we've talked about before, but I want to step back and think about what that is again. Okay, price to earnings ratio is the dollar amount you're willing to pay for a company per dollar of earnings. And what that means is, hey, if your local coffee shop made $100,000 last year, okay, and you are willing to pay $1 million for that coffee shop, that would be a 10 times price to earnings, right? You're willing to pay 10 times the last year's earnings, the $100,000, to buy the coffee shop. That could be a good deal if the shop was growing. You were going to double your profits next year, double after that. You're going to make your money back in a couple of years. Now, if the price to earnings starts to get too far ahead, say you're paying 20, 30, 40 times the earnings, that starts to get a bit concerning, and you start to think, well, am I actually going to make this money up? Okay. So what this chart does is it breaks the market into 5 quintiles. Okay. So the top 20% most expensive by price to earnings, down to the bottom 20% most expensive, or the least expensive. And this is our cause for concern right now. So the top 20% most expensive companies, the companies that have the highest price per dollar of earnings, are by far outpacing the rest of the market. And what that means is a lot of this growth that we've seen is optimism that's raising the price. And even though the earnings have been solid, like the price is outpacing the earnings even. So the earnings will need to continue to accelerate to maintain this price that's being priced in right now. And we've got some interesting data on why or what tends to happen when that's the case. And you can see here. So what this shows is the more expensive, the higher the price to earnings ratio gets further to the right. Okay. And then the relationship between that and the returns, the annual returns for the next 10 years. So higher would be better returns. Okay? And you can see that, hey, when there's a low value, when the price to earnings is relatively low, meaning it's cheap, the next 10 years look pretty solid, right? 14, 16% a year. The more expensive you get, the lower future returns that you can expect. And right now, the S&P 500 in general is at about 21. Okay. And if you look at S&P 500 returns in the past, when it's averaged around a 21 price to earnings ratio, the next 10-year returns have been pretty low, okay, in the single digits each year. So, something that we're doing within our portfolios, what we're encouraging people to do is look at how you're invested and see if there are ways to lower your average valuation in your portfolio. See if there's ways to buy companies that are at a lower PE rather than these, really expensive stocks that have seen such a massive run lately.
Mm-hmm.
So, David, going into that, we've talked about price to earnings valuations. Another big concern right now is inflation. It's coming down. Maybe it's not where we want it to be, but can you talk about the relationship between those and how those work historically?
Definitely. So First off, also was just talking about the fact that the S&P 500 price to earnings are about 21. And the kind of interesting thing about that is not so far away from where we should be, right? So the S&P 500, the average price to earnings is 15 times earnings. Right now we're at 21, but if we look at the average when inflation is between 2 and 4%, that's where, we are right now. And if we look at that, the average PE ratio here is 18, right? So we're about three times higher. So while these companies are a little overvalued, they're not as overvalued where it should be so concerning that they're going to go fall tomorrow and you should make all these changes. But there are concerns that that is starting to drift away, which means the potential future growth of those companies is less, essentially, right? The future outlook is not as great because they're already very highly priced. And that was represented as well by that dot plot on the prior slide, which essentially showed that the next 10 years, right, is looking like maybe, mid to mid single digit type returns over the next 10-year stretch. That doesn't mean it happens next year or the year after, but over the next 10 years, you're probably looking at some slightly lower earnings. Now, going back to this, the Fed's target is to bring inflation below 2%, right? So they're looking to move us over to this first bar, which would put the average price to earnings at 19. That would, or 18 and a half, essentially. So that would be, a little bit closer to where we are now. And the market, we need to remember, is always very forward looking, right? The market is anticipating already inflation comes down to 2%, which enables these price to earnings in order for them to come down, right? Or sorry, to go up, for the PE ratios to go up. So, speaking of inflation coming down, right? CPI has really come down. Last year we had some pretty high inflation. I think we peaked at 9.1%, and it's been 2022. And CPI has been coming down, since then. And then you'll notice it's kind of leveled out, lately. And we actually had a couple inflation readings the past couple months that were higher than expected. And essentially what that's going to do is that's going to have some implications on rates getting cut, and rates getting cut would essentially stimulate the economy, right? Which would help. That would make mortgages cheaper, car loans cheaper, business loans, which, for the record, a lot of companies in the market, right, take business loans to create new products, expand on marketing. So there's bigger impacts for rates coming down than just for the everyday consumer. So Austin, can you tell us, kind of why did inflation level out here? Like, why hasn't it kept dropping to get to the Fed's 2% target?
Yeah, so the Fed's in a sticky situation right now because their worst nightmare is that they reduce rates too quickly and inflation does this, right? That's kind of what it did in the 70s and into the 80s, when we saw this peak in inflation. It came down, and then the fiscal policy eased too quickly, which sent inflation rocketing back up in the other directions, when you saw 15% mortgages, things like that. And that's what the Fed is trying desperately to avoid right now. And so they're in this sticky situation where they're seeing kind of the impact of rates, but then they're also seeing things like this. They're seeing that the economy, regardless of rates being high, is seen, by the data would say the economy is strong, right? Jobless claims are low. That means unemployment is low. Employment is high. People have jobs, and the job market is still tight. You see things like consumer consumption remains high, actually higher than average. If you look at this trend line for consumption, right, which is really what our economy is based on, is consumption. You can see that post-COVID we had this massive spike that's starting to taper off or come back, down towards average, but hasn't done that yet. Consumption is still higher than average, and so this is adding to this, combination of the things that the Fed's paying attention to, where they would love to start lowering interest rates, but they don't want to do it too early if the economy is remaining strong and cause inflation to reaccelerate. But they also don't want to be too late, and find ourselves in a recession before they can do something to stimulate it. And part of what's fueling that other side of the argument is what David's about to get into here.
Your Slack popped up.
Where yeah, I saw that. Sorry about that, guys. What David's about to get into here, which is kind of what this level of consumption has been doing to the consumer in the U.S.
Yeah. So to share a little bit about that, this is very similar to that chart Austin just had on the screen, but all of this spending, right, is starting to lead into some debt here, right? So if we look at US households are paying more in non-mortgage interest, right? Credit cards, car loans, personal loans, they are paying a lot more money in interest than really they have since the 70s, right? And if we kind of look at this comparison of non-mortgage debt versus mortgage debt, you'll actually notice that we just crossed over. Actually, there being more non-mortgage debt and interest being charged than mortgage debt. And mortgages are, almost at 7.5% right now. So when you consider the fact that people have spent that much money, right? And part of that has to do with, COVID happened and people started cutting back on spending, and then things started opening back up and people started really spending a lot more money, right? Debt was cheaper. There's more stimulation and money in circulation, and that those spending habits haven't changed. And essentially, we had a chart in a previous market commentary where we were explaining how the amount of money that the average household has on hand has been really decreasing since COVID, whereas during COVID it had spiked, and now we're at a point where people have spent all that extra reserves that they had essentially accumulated during COVID, and the spending habits aren't changing, which means we're actually anticipating this debt to really kind of continue, but it can only continue for so long, right? Until these credit card companies, et cetera, say, hey, you got to pay. So what we're anticipating is we're actually looking at seeing spending start to slow down here in the near term. Now, if we think about how that relates to the overall market, that means that these companies are going to have less earnings, right? And we already have this happening actually around half of the country right now, just about. So if we look at the number of states with declining GDP, and GDP means essentially, more production than spending. And when we look at this, we can see that we're pretty close to the average threshold here, that 25 or half of the states have a declining economy, which is a little alarming, right? Because if we look at this chart, you'll notice every time so far on this chart since 79 that we have exceeded 25 states, except for 2021, that has led to a recession, right? And the recession you would see on this chart with the gray bar that goes completely vertical across the whole chart. But every other time other than, 2022, not 2021, and we got very close in 22. Some might even argue that we did have a recession in 22. But we are very close to that line. So we're not out of the woods on a potential recession. And if something doesn't happen here in the next year or so to kind of bring these states down a little bit, then this metric for looking at, potential recession would indicate that we are heading a little bit more in that direction. However, there's always two sides to the story, right? Well, there are a number of economies that are looking weaker. There are a lot of economies states that are looking strong. California, Florida, and Texas are amongst some of those. That could also be due to, in Florida and Texas's case, a lot of people relocating right during COVID and afterwards now with remote work. And New York would be the other kind of major economy on here, which is starting to weaken. But essentially, when we look at this, we can see the states that are in a economic contraction, which would be the part that is lowering or have negative GDP. All of those states are highlighted here in the red. I know with the federal government, a lot of you might be like me, originally from the Northern Virginia, DC, Maryland area. And you'll notice that a lot of those surrounding states there are currently in the decline. That doesn't mean that they're declining sharply and that should be a major concern. But what would be more concerning is if we see other states start to join in this negative trend. And this is what the Federal Reserve is hoping to essentially work through here, where they got to really, find a needle in a haystack and they have to thread the needle perfectly here to help us avoid a recession, but also keep inflation down. And when they learned from the past, which is why they raised interest rates so quickly, right, over the past couple of years. And I'm going to let Austin actually kind of explain what this negative GDP and everything, how that impacts essentially interest rates, right? Because that's what I think a lot of us are most concerned about is what's going to happen with rates, because that's going to impact the stock market, the bond market, the housing market. That impacts a lot of things. So Austin, let's talk about that.
Yeah. So like David said, right, in blue here, you can see the federal funds rate. So this is the rate that the Federal Reserve sets. And then that kind of determines every other interest rate, what bonds are going to be, or what bonds are going to pay, what consumer debt rates are going to look like. And typically, when you're thinking about consumer debt, like mortgages, car loans, things like that, they're going to follow the 10-year treasury, which is this yellow line here. And the 10-year treasury isn't going to move quite as fast as the federal funds rate. This can really raise and lower on a dime. But the federal funds rate, or the 10-year treasury, is going to be, it's going to be a little slower to react because that's debt that's going to get paid for 10 years. So if the general consensus is that, well, rates are going to come down eventually, then that's why we can see this yellow line, the 10-year treasury has kind of floated around this 4% line, kind of anticipating that rates are going to be coming down. Now, what we've seen is that right about here, okay, early 2023, the Fed started to get data that, hey, inflation's coming down. All these rate hikes that we've done for the last 2 years have been working, right? So inflation's coming down, and we're gonna pause. We're gonna pause here on rates. We're gonna keep them right here. And you can see after they announced the pause and people kind of felt good about rates not coming up, we saw a nice drop in treasuries, so in treasury rates, and you might have seen that midway to the late side of 2023, we actually saw mortgage rates kind of come down a bit. People were optimistic that rates were going to start getting cut, and we started to see that roll out through bonds and through consumer debt. Now, because of what we had just been talking about, right? Because the economy has remained so strong, because unemployment is low, because the Fed doesn't want to cause inflation to reaccelerate, and inflation has not come down to that 2% target yet. It's being kind of stubborn. The Fed has just held this rate, okay, and they've held it right around 5.25%. And because of that, you're starting to see some of these bond rates ease back up again, saying, okay, we might be higher than we thought for longer than we thought. Maybe we're not going to see 6 rate cuts in 2024 like we thought we were going to see. Maybe, Now what the market is forecasting is about 3 rate cuts in 2024. And what I would caution you to be prepared for is potentially even less than that. The Fed's primary job is to not allow inflation to reaccelerate. And if the economy remains as strong as it has been and inflation remains stubborn, they're not going to be able to reduce these rates in good faith and kind of allow and stimulate the economy further when it's doing so well. They're going to have to wait for some amount of slowdown to actually start decreasing. And they could be looking at data like what we saw with almost half of states being in potentially declining GDP territory. But of course, they have the whole country to keep in mind here. So it's going to take a little bit more likely for the Fed to be comfortable with decreasing rates. Now, yeah, that means that mortgage rates might stay higher for longer. It means that, but there's some positive news that comes with it as well, right? Bond funds like the F fund and your TSP are paying good rates now. Likely better than the G fund at this point after being so weak for the last 2 years. And even the stock market, if we look back historically, if at the longer the Fed pauses, okay, out to the right being longer, we can actually see that the market has appreciated that. Okay, this is looking at the S&P 500. If we look at a couple of these short pauses in history where the Fed paused and then started declining too early, the next year in the market, actually didn't perform very well. But if we look at these longer Fed pauses, the market actually typically appreciates that and performs well during pauses. So, David and I were laughing about this before the presentation. That this presentation and the last few have been. It's been difficult for us to put together a cohesive thought on, hey, this is what you should think or this is what you should think, because there's so much competing data. There's positive news, there's negative news. The economy looks strong, but if the economy is too strong, then we're going to see inflation happen again. And it's just such a, it's a primary example of why you should be diversified in your portfolio, right? Nobody's got the crystal ball. We don't know what's going to happen, and you need to know your risk tolerance and know how to diversify. So we've got these tips, and David will take it from here on kind of how you should approach this current environment.
Yeah. So essentially, for anybody who's joined, this is pretty common to kind of talk about, but maintaining a balance of growth companies versus value, especially earlier when we talked about essentially how those 5 companies or 6 companies have really been kind of paving the way. Those are all considered growth companies. Value companies are going to be a company where they're considered a fair value, something like a Walmart or a Costco, where they're kicking dividends back to investors, and they essentially don't need to reinvest all of their earnings back into the company to continue growth, right? An example I give people is you can only open so many Walmart locations, right, before you're opening one just for the sake of opening one. Same thing with Costco. It's got to make economic sense. So these companies have extra earnings and they kick that back to the investors. Those companies tend to do better when markets go down, right? Or when prices are overvalued during a downturn, they may hold up better. So you want to make sure you have a good blend between the two. I know a lot of you on the line here are investing in TSP. With that, your C fund, for example, is going to have a tilt towards growth. So you're going to want to use outside investments and other things to kind of balance that a little bit better. And we like the idea of having a pretty close balance, right? Almost a 50-50 between the two. Next thing is being mindful of concentration risk, right? We spent a lot of time talking about that, especially when it comes to the C fund. The C fund is really what we were highlighting today. That's where most people are putting the majority of their money, is the C fund or the S&P 500. and it's done a phenomenal job over time. But there are certain times where maybe trimming some of that risk or diversifying a little bit more makes sense. And some of the ways you can do that is here in bullet number 3, invest in small and medium-sized companies, right? The S fund, TSP also has, mutual funds now as a potential option. Outside investments, or even if you move money out of TSP, looking to use some of these other diversifiers. Actively managed international can also be a good diversifier. Now we put actively managed there intentionally. This is not the I fund at TSP. Actively managed would be somewhere probably on the outside or potentially under TSP's mutual fund list, where you can get something where it is being actively traded and managed, because the international environment is very different than domestic. And then finally, don't be afraid to use bonds as a portfolio buffer, especially as we start to see rates come down. The bond market should really improve. And let's remember, the bond market hasn't recovered yet from the past 2 years. It is still down, I think, about 18% from its total, from its top. So there is going to be a recovery eventually in the bond market here, and that creates opportunity. So don't be afraid to use the F fund in TSP. We might be a little bit early, but as soon as they cut rates, you'll really start to see that do better. And remember that that is a lower risk, right, than your stock options. So a few other pieces. Don't let your emotions drive your decisions. You want to have data-backed decisions and understand your risk tolerance. I know you said this the past few times, but the stock market has continued going up. Well, the stock market is high and the bond market is low. If you are taking too much risk or potentially too much risk in your portfolio, your window is probably closing here to make an adjustment to your portfolio. So if you think you're taking too much risk, you're approaching retirement potentially, this might be the time to make that adjustment to your portfolio. It wouldn't surprise me, or probably Austin, if we had a little bit of a slump here during summer. So that's something that you're going to want to keep your eyes on, especially with a sell in May and go away kind of philosophy. With your portfolio, like we were just talking about, you want to be diversified. Don't put too much in the sea that you have so much concentration to these big tech companies. And then finally, you want to stay invested. If we do have markets correct here later this year, this summer, don't be reactive to the market decline. If you haven't made the change ahead of time, then you should ideally wait it out until things have already recovered and then make the adjustment to your portfolio. You never want to be in the situation where you see things go down and then you move everything to G, or you make a rash decision like that. That more often than not doesn't work out. Now, for anybody watching, whether it's live or the recording here, we do offer a financial checkup. Some of the main questions that we address are listed on the screen here. All of these are essentially discussed and covered throughout that call. Anybody who's a client, you definitely know how to reach us, and we can have a meeting at any point in time. We also have the QR code to schedule that meeting for anybody who is interested.
Yeah. So thank you everyone for sticking on so far. We will stick around for some questions here. You should have a chat feature that you have access to that we can see through our side. So feel free to type questions in the chat if you have those, and we'll get to those as we can. Again, all of this info is sticking on our YouTube page now. So this webinar will be recorded. It'll stay here. We also have a lot of other content that's coming up on our YouTube page. So if you haven't yet, please subscribe to the page, like the video. That helps more people see it. And David, have you seen any questions come in yet?
No, I have not. No questions in yet. So we'll just give it another minute here in case anybody does have questions. And just in the meantime, I'll kind of elaborate a little bit on, I had, very briefly mentioned this sell in May and go away type philosophy. So to elaborate a little bit, essentially the stock market from May to October, right, during your summer and early fall months, the market tends to not grow as much as it does, or nearly as much as it does from November to April. So there's a old saying that came about called sell in May and go away, which essentially means that you would go to cash or treasuries during summer, and then you'd be in stock investments during the winter and spring. Now, the average return of the market, the stock market during the summer months, the May to October, is 1.4%. The average return from November to April is 6.4%. Now, there are investments out there that actually implement this philosophy, and I'm not going to lie, they don't look good over the long term. However, you can use this information to make certain decisions, like the risk that you take in your portfolio. If you're not going to potentially earn as much return during those summer and fall months, and you're taking too much risk, and the data suggests that, hey, the market's not going to do as well during summer, it's a good time to lower your risk, right? So like I mentioned earlier, the stock market's at all-time highs. We're heading into the period where the market doesn't grow as much, and the market has grown a significant amount over the past 2 years. It's one of the best times to potentially look at lowering risk if you're in a inappropriate risk level. Now, you don't want to try and time the market and get out and then get back in. Most of the time that doesn't play out. Even hedge funds who spend hundreds of hours, right, and their employees are working 80, 100-hour weeks, they guess it wrong most of the time. So don't use this to try and time the market, but use this towards, hey, if I'm in the wrong risk, I can use this information to make an adjustment to my portfolio.
Yeah. And just one thing to add in there, even on that last slide that we always show on these, and it probably gets repetitive, but we say, don't let emotions drive your decisions. Most people think, oh yeah, that applies when the market's down. I'm not supposed to buy, I'm not supposed to sell when the market's down, but it also applies when the market's up. When the market's up, everyone thinks they're a genius, right? Everyone's making money. They're all doing the best thing. And it only makes sense to be growth, to be aggressive. Because you don't want to, you've got that fear of missing out, right? You've got the FOMO, and you don't want to miss out on any of the gains. But hey, smart investors keep a level-headed approach no matter what's happening. If your risk tolerance says you should have 30-40% bonds in your portfolio, you should keep 30-40% bonds in your portfolio, even if the market's doing incredible, because it's so difficult to kind of to time those changes. So yep, good info here. We've seen a couple things come in, a couple comments come in, but no questions. So David, I think we wrap it up here.
Yeah, thanks everybody for joining. Hope you all have a great spring. Good luck to anybody wrapping up their taxes here before the deadline. And if you have any questions, you know how to reach us. So thanks everybody for joining, and hope you all have a great spring.